The subject of today's webinar is profitable Forex trading. Now, there are probably thousands of indicators out there and thousands of mechanical strategies, and you could spend days reading about all of them. But if you Google type of data or best type of data to use for intraday trading, you don't find very much information. And the type of data that you use is extremely important, because you want to eliminate or minimize noise with the data that you're using. And noise is choppiness, consolidation, balance, and equilibrium. Noise occurs when neither buyer nor seller can gain control of the market. Noise is inefficiency. So bars plotted on time are not efficient bars, because you don't trade based on time, you trade based on price. So if you just put bars in based on 1 minute or 3 minutes or 5 minutes, you're just adding noise to feed whatever indicators you're using, and that makes the indicator then less efficient. So that's why I like Renko bars. Now, I don't have time in this presentation to go into all the details why Renko bars are the most efficient type of data to use when you're trading, but there was a previous webinar I did, and if you go to my website, NinjaIndicators, the number 4, the letter U.com, hover over videos and then hover over webinar, you'll see webinar 2, and if you click on that, I go into considerable detail in that webinar and compare the various types of data, and come to the conclusion that Renko bars are the most efficient type of data to use when you're day trading. Now, of course, equally, if not more important than the data that you use, are the type of indicators that you use when you're day trading. Indicators must account for all possible price movements. Now, equities move in one of 4 ways. They cycle, they trend, they cycle within a trend, and they consolidate. You can make money on 3 of these 4 movements, but you have to have indicators that indicate at the very beginning of such a movement, so that you can get in at the beginning, and then you also have to have an indicator that lets you know when that particular equity is overbought, and lets you know when it's gone just about as far as it's going to go, so you can get out at the most profitable time. Now, something that's quite helpful in trading are price action trend lines, and that's a way to make a lagging indicator into a leading indicator. Now, if you look up price action trading or Google price action trading, for the most part you see that candlesticks are used in the trading. Now, this really doesn't make much sense to me, because price action means exactly that, price action. If you're using candlesticks, that means you're using time in your data, and time and price action are 2 entirely different matters. So it makes much more sense, if you're talking about price action, not to use time in the equation. Now, many years ago, when I first got interested in technical analysis, and I didn't know anything about it. I didn't know anything about back adjusting, repainting, back painting, anything like that. I came across the zigzag indicator, and then when I saw it, I thought, oh my gosh, this is the holy grail of indicators. Look at this. It marks every turning point in the chart. Well, it didn't take me long to figure out, wait a minute, this was all done after the fact. And I realized the zigzag indicator was kind of like the coroner, because the coroner can tell you exactly what's wrong with you, but it's always a day too late. So I did realize, though, in looking at the zigzag indicator and the turning points of the zigzag, if you connected these turning points, in other words, connected higher lows and connected lower highs with a trend line, very often that would be a significant trend line. Now, if you take 10 traders and show them an equity and ask them to draw trend lines on it, you'll probably get 10 different trend lines. A trend line that's drawn on a chart that is not a significant point of that chart is meaningless, because that means that everybody else who's trading really doesn't see that trend line if it's not obvious, and therefore that trend line, almost by definition, is going to fail. So anyway, I decided this was an intelligent way to draw trend lines on a chart, so I wrote an indicator in easy language that did just that. And I thought, this is going to be really great. So I plotted the trend lines, and was not as good as I thought it was going to be. I was disappointed in the results I got with the trend lines. And I still like the idea of trend lines, but it just didn't seem to work out on the way I was using the data. So I kind of put trend lines on the back burner for a while. Then I think it was around 1994, Steve Nyssen came out with a book called Beyond Candlesticks. And I got two things out of this book. One was Renko bars, which he introduced to the West from Japan, and the other was the disparity index, or DIX, which I'll go into a little bit of detail on that indicator later. Now, price action trend lines are helpful in trading, but they're obviously not the holy grail of trading that I was hoping for originally. Something else that is very important, particularly in intraday trading, is overbought, oversold detection. Now, I'd always been unhappy with the indicators available to determine when the equity was overbought or oversold. Generally speaking, most indicators for that purpose are cycle oscillators, and they cycle between 0 and 100, and they have a fixed overbought line somewhere around 80 and a fixed oversold line somewhere around 20. And if the indicator goes above 80, that means it's overbought. If it goes below 20, that means it's oversold. But it doesn't tell you anything. Yeah, that's nice. It's overbought or it's oversold, but so what? It can stay that way for a while with the conventional overbought, oversold detection indicator. And I read about these indicators, try to find some indicator that worked better than that. And one of the common indicators it seems that's used is the Williams %R. And I looked at that. It just didn't do anything for me. I didn't see where that indicated really overbought, oversold. So I just had an epiphany one day, and I realized that overbought, oversold are relative terms. They're not absolute. Because they are relative terms, fixed overbought, oversold lines just don't make sense. So I wrote the swing cycle VB indicator, which has a variable band as an overbought, oversold line. And when I did this, it all made sense. Suddenly I realized that you could determine very precisely overbought, oversold levels right at the appropriate time when they're going to change, and you can take advantage of this. And before I wrote the swing cycle VB, it was just impossible to take advantage of this. And after I wrote the swing cycle VB, I often thought, I don't know how I traded before I started using the swing cycle VB, but we'll go into that shortly. Now here's a shot of the US dollar Swiss franc with some trend lines on it. Now the bars here are colored with the triangle trend paint bar, which colors the bars based on volatility. And these are 4 Renko bars. right here, and which means there are 4 pips in each bar. Now you can see the dots here and here, and those represent turning points of a zigzag indicator. Now you can call them swing points, pivot points, turning points, whatever you like. There is a free indicator called the Zigzag UTC, which you can Google and download, and I use that to put the dots on here, and I set it to put the dot in after 2 bars form in the opposite direction. So in other words, after these 2 bars go in, the dot is placed here. This dot is placed after these 2 bars go in. And there is a indicator that comes with NinjaTrader called Auto Trend Lines, and that puts trend lines in on these turning points here and here and down here. Now it always puts the trend line through the last 2 turning points. So when that trend line is crossed, very often there's a significant move in that direction, and so this trend line produces support, and this trend line produces resistance. So when it's crossed, there's a significant up move here. Now there's 2 caveats I have to mention about these trend lines. One is every trend line crossed does not result in a profitable move, and every profitable move is not necessarily preceded by a trend line. So as long as you keep this in mind, then you can use trend lines quite profitably. Now something else that these turning points indicate, and that is, this is support right here. It bounces off support, hits resistance here, comes back, hits support here, hits resistance here, and then goes back down. So these areas on here are support and resistance, and that's why when support or resistance is broken, very often you get a significant move, but you need other indicators to determine this. You can't just trade with these price action trend lines alone. Now the other thing I wanted to mention on this chart is it starts around 4 o'clock in the morning over here and ends around 2 or 2:30 in the afternoon. So that's 10 hours of data on this chart, and you can see how nice and relatively smooth this data is. And interestingly enough, where it starts over here is pretty much where it ends over here. So from the beginning to the end, if you look at those 2 points, it doesn't go very much, but it's all the movements in between that count. Now, here's a 1-minute chart of the same data, US dollar, Swiss franc, and this is starts at around 10:30, and it goes to let's say 2:30. So 10:30, 11:30, 12:30, 1:30, 2:30. So there's only 4 hours of data on here. So that's 6 hours less of data than was on this chart right here. So why is that? Because it's less efficient, because it's so many more bars, so much more noise in here with 1-minute data as opposed to the 4 Renko. Now here's a 500 tick chart, and it starts around 7 o'clock in the morning and goes till 2. So there's 3 hours less data on this chart. Why? Because there are 3 hours more of bars on here, so you can't squeeze this movement into one screen. And it's the same with a 4 range chart. Here again, it's 3 hours less data that you can get on the chart, so 3 hours worth of inefficiency when you compare the 4 range with the 4 Renko bars. Now here we come to the DIX indicator that I mentioned earlier that I got out of the Beyond Candlesticks book. Now I didn't write the DIX indicator, but I did color code it, and I put a 0 line in it, which I think is significant. And I think indicators that are color coded are much easier to read than ones that are not. Now The tricky thing about the disparity index, or DIX, is that what moving average you use in this indicator and the length of that moving average. So I experimented with lots of different moving averages and lots of different lengths until I finally came upon one which I think works really well. And this is a whole moving average, and this is the moving average that I use in this indicator. And the way the indicator works is when the equity closes above the moving average, the indicator turns green and moves up. When it closes below the moving average, the indicator turns red and moves down. Now, you hear a lot about lag in moving averages. Well, the DIX totally eliminates lag. Now, you can see over here, the equity closed above the moving average right here, and as soon as it did, the DIX moved up here. So zero lag with the DIX. Now you can see the lag in the moving average. It goes down here and over and doesn't start up till somewhere in this area over here. But you totally eliminate that with the DIX. So the DIX is very good for short-term movements. And the DIX is a much more nuanced, much more sophisticated indicator than simply using a moving average. You can see it, equity moves down a little bit below the moving average here, which is indicated quite clearly on the DIX. Now this is the Euro US dollar Forenco, and with the trend lines plotted, and you can see here was a significant move when this red trend line was broken right here, and this trend line was put in right here after this bar formed. So it was well in advance that it went up here long before it got to this point of crossing below the trend line. Now, as I mentioned, the auto trend line puts the trend line in the last two turning points. Sometimes it's helpful to have the indicator keep this. Well, the indicator doesn't keep the trend line in here, so you have to draw the copy of the trend line. So initially the trend line went from here to here and went up here. So when it did, I made a copy of it, and so then it looked like this. So when the auto trend line put the new trend line in, I kept the old one in here. And so you see in this particular case there wasn't much difference between the two trend lines. It just went up here, and there's just a fraction difference between the two, not significant. Now this was more significant. Here's the trend line, comes down here and crosses this lower high right here. So I wanted to keep this trend line in place, so I copied it. And the way you do that is you left click on the trend line, this little screen comes up, and then you make sure you unlock this, uncheck this little box that seems to be the default here, and then you right click on the chart, and then you paste that trend line in here. And the significance of that is there is a turning point right behind this screen here, and so this another lower turning point came in here. So the auto trend lines erased this trend line here and put this trend line in here. But because I had drawn trend line in, or copied it rather, I got this in much earlier than the cross of the trend line up here. So it enabled me to go long much sooner than if I would have waited for this trend line in this point. Now, if you recall, I mentioned earlier that every cross of a trend line doesn't result in a significant move, and every significant move is not preceded by a trend line. So here we have this trend line between these 2 points. Now, if I would have drawn this trend line between these 2 points and kept it in here, it would have come out somewhere out here and wouldn't even have had this thing to think about right here. But you can see it was not a significant move when it crossed below here. And I wanted to mention that the DIX is a pretty good divergence indicator too. You can see it made a low right here, and then this bar here you made a higher low here, and then this bar here, which was actually lower than the original bar, this is actually higher here, even though this bar is lower. So it's a very nice divergence indicator, which indicates that this is not going to be a tradable move down here. And also this little up move here, when it crossed above this trend line, the DIX started moving down here, which is kind of an ominous sign that this is not going to be a tradable move either, right here. Now here we come to the swing cycle VB that I mentioned earlier. Before we get into this indicator, I wanted to mention that how the triangle trend indicators are connected, and the connection that is what I call disparate synergy. Now that may sound like a contradiction in terms, because the dictionary definition of disparate means fundamentally distinct or different, and synergy is defined as two or more things functioning together to produce a result not independently obtainable. Now my explanation for this is that my individual indicators are analogous to musical instruments. Musical instruments are disparate in that there are, for instance, string, wind, bass, percussion, etc. But put them all together in the hands of individuals who know how to use them, combine all the elements in harmony, working synergistically, and you have an orchestra. In the same way, the triangle trend indicators are a disparate group that are combined synergistically to form a profitable trading system that will orchestrate profits for you when used correctly. To continue the analogy, if a college orchestra in the New York Philharmonic used the same combination of instruments, I think you would agree the results would certainly not be identical. So it's important how the indicators are used, and decisions based on these indicators is where the discretion part of discretionary trading comes in. Now on the swing cycle VB, this is the indicator itself, this dashed line right here, and this is on the euro, the US dollar combination. And this white line here is the variable band. Now you can see the color changes in the swing cycle itself. Now what the color changes are, they come from a detrended momentum oscillator that I wrote and I incorporated into the swing cycle VB code. And all the momentum oscillator does is color the swing cycle indicator. It has nothing whatsoever to do with the movement of the indicator itself. So when momentum is moving up, it colors the swing cycle green. When momentum is moving down, it colors it red. And when momentum is below zero but moving up, it colors the indicator yellow. And you always want to be a little bit cautious when it's colored yellow. It means momentum is below zero, and generally speaking you don't get significant movement unless momentum is above zero. And one other thing I want to mention, there's a little red area on the variable band right here, and that represents a Bollinger Band squeeze. Now if you're new to trading, a Bollinger Band squeeze occurs when the Bollinger Bands move inside the Keltner channels, and the significance is when the Bollinger Bands expand out of the Keltner channels, generally that indicates a tradable. Now when the swing cycle crosses above the variable band right here, that indicates the equity is oversold. Now you can see the equity has trended up through here across this chart, but it's also cycled within this trend, and so that's one of the four movements that equities make, is they cycle within a trend, and this is an example of that. So in any event, when this crosses above variable band, that means this is oversold here. Now over here you can see the level of the variable band right here is at 80. So if you come across here, this is 80 right around here. And so with conventional indicators for overbought, oversold, when it crossed above this level right over here, then that would mean it was overbought right in here. But you can see it's not anywhere near overbought right here. And so that's the fallacy of the conventional overbought, oversold indicators. It doesn't get overbought till here, and that's when the swing cycle crosses below the variable band right here, which indicates this is overbought, relatively speaking, relatively so, because then the swing cycle comes down here and crosses above the variable band right here and turns green right here, which means this is oversold. Now this was also oversold, and this is higher than this, but that's why I say overbought, oversold are relative terms. Then it comes up here, then the swing cycle crosses below the variable band right here, which means this is relatively overbought right here, and it moves down here, the swing cycle crosses above the variable band right here, which means this is relatively oversold right in here, and then the swing cycle starts down here, which means this is relatively overbought right in here. So you can see how clear and easy it is to detect overbought, oversold levels, and how obviously you can profit from that. Now here's the British pound US dollar, and here there's many more squeezes come in here, and so the swing cycle crosses above the variable band here, which means this was oversold right in here. It crosses below the variable band right here, which means this is overbought, and comes back up here, which means this was oversold, and now it comes down here, turns red right away, means overbought right in here, relatively speaking. Now the swing cycle VB is a leading indicator, and you can see that very clearly right here. It turns red right away here and starts down before this bar forms over here. So by the time this bar is formed, swing cycle is already way down here and it's already red. So you know that this is going to be a down move right in through here. And then the move comes to an end right here. This is oversold right in here when this crosses above the variable band right here. You get a squeeze right in here, and then it goes on up this way. So now the question is, when the variable band is crossed right here by the swing cycle and the equity moves down here, is this a retracement in this uptrend, which at the time you only see this, you're not seeing the results of this. So the question comes up, is this a retracement in an uptrend, or is this the beginning of a downtrend? So in other words, should you get out of the trade when this crosses below here, or can you stay in the trade, ride this little down movement down, and get back in up here? Now of course that depends on your trading philosophy and how you trade the equity. I mean, you can very easily play it safe and get out right here when this crosses below here and get the maximum profit from this move right here to here, and then you can get back in over here when this crosses above the variable band and comes right up in here. Now the other thing I wanted to mention while I'm thinking about it is this is the triangle trend indicator itself right here, and notice how the bars of the equity sit right on the hypotenuse of the triangle. Now there's an input to the triangle trend indicator that will plot the level of the hypotenuse in any one of the four corners of the chart that you like, and then you can use this level to set a trailing stop if you like. Now the triangle trend indicator is set so that it doesn't plot until the bar closes, so this level will be right here until this bar closes here, and this level will be here until this bar closes here. So it doesn't plot intra-bar, in other words. The other thing with the triangle trend indicator, when it determines that the trend has come to an end, it puts the final leg of the triangle right in here. So until this point, this was an open triangle right here, and then this leg finally formed when the equity moved down here. Same way, this leg, which might be difficult to see, is right here, and it formed when this bar formed right here, and then the equity started up again right in through here. Now this is another indicator, or this is what was based on my creating another indicator in the triangle trend package. Now this is the DI plus DI minus ADX indicator, and I think you'll agree this is not really clear to tell at a glance what's happening with this indicator. And also there's a certain controversy about the ADX. The question is, does it have to be above a certain point to indicate a trend, or is it the direction of the indicator itself, or a combination of the two? So based on that indicator, I wrote the DMI differential, and I think you can see it's much easier to read than this. And so it's kind of like the optometrist says, better here or better here. Well, to me it's obvious it's better here. Now this is a totally different, this represents the ADX, but it's a totally different indicator than the conventional ADX. This is kind of my version of the ADX right in through here. So you can see very clearly when a trend starts, the dots turn green and the indicator line moves above the dots and turns green. So this trend coincides right with the swing cycle coming up here. Incidentally, I should have mentioned, and I don't believe I did, was that I never changed the inputs on these indicators, because these indicators work together synergistically. If you change the inputs on one indicator, then that throws the synergy off with the indicators. So all examples on this webinar are with the default indicators and the default settings on all the indicators. Now, remember when I talked about this pullback here on an uptrend? Now the DMI differential is very helpful to use once you're in a trade. It can keep you in a trade long, because you can see right here, as long as this stays above the zero line and stays green, that means the trend is still in place. Now you get these 6 dots right in here, which just means a downward bias to the equity, but as long as the indicator line stays above these red dots, that means the trend is still in place. And now over here, you would get out of this trade when the swing cycle turns red and crosses down here, because when it turns red and moves down, then you know right away there's going to be a down move, as opposed to right here when it stayed green and moved down, and you didn't really get any down move here until the indicator turned red right down in here. So you don't want to wait till the trend changes before you get out of a trade. And so here's where the cycle moves down here, and this is where you would want to get out of the trade, and this is where you would maximize your profits right here. Now this is another indicator in the package, and it's called the binary triangle. Now the binary triangle is based on the triangle trend, except it's a binary indicator and it's plotted intra-bar. Now notice over here, when the equity is choppy, it forms these little diamonds here, up and down and up and down and up and down on this choppiness right here. But you can see the DMI differential didn't turn red on any of these little down moves. It stayed green, stayed up here. So even though you hit choppiness here, you can still stay in the trade by using the DMI differential here. Now I also like to plot the DIX in the same subgraph as I plot the binary triangle. And generally speaking, when the DIX turns green and starts up like it does here, and you get an up triangle here, which forms earlier than you can really see the triangle forming right here, because you can see in the binary this is an up triangle here, and it's just when this forms you don't see all the rest of this, so because it's on the right edge of the chart. So you can't be sure this is the beginning of a triangle, but you can be sure when you see this, so you know there's going to be an up move here, and so you can take advantage of these moves. By the same token, you can see how early the DIX moved down here, and it's red and moving down when this red down triangle forms right up here, right before you can really discern triangle trend up in here, so it gives you a very early picture of it. And then you can see this divergence between here and here. Actually, you can see the divergence between here and here and here. So this shows the peak of this move, and then this moves down here and comes back up, and much lower peak, even though this is higher here. So you get a very nice divergence within the indicator here, which is another reason that you would get out of this long trade right in here. Now this is another indicator in the package, and it's called the random walk oscillator. Now Linda Raschke likes the random walk index. I think it's random walk index is kind of hard to read in the midst of trading, so I wrote the random walk oscillator and kind of did with the random walk oscillator what I did to the DI plus DI minus ADX with the DMI oscillator, or differential rather. In any event, when this crosses above the zero line and the zero line turns green, in this case, well, when the zero line turns green, that indicates an uptrend right in through here. So you can see how these all line up here. This is already up here when this changes, and so this is up here. So you would go long right around in this area. Now notice there is no trend line in here, but this is a significant up move. So this is one of the caveats I mentioned in talking about the price action trend lines. You don't always get a trend line before there's a significant move, and this is one of those cases. Now what the random walk oscillator does is it measures the strength of the trend. Now you can see the strength of the trend ended right here, and it starts to move down here. And now this is more sensitive indicator than this. Now they look very similar, and they look similar even though they have totally different codes, is because they both measure trends, but this is much more sensitive than this. So this is why this is kind of good to stay in a trade, because you don't get out of the trade based on any head fakes to the in the opposite direction. But this shows, since it's being more sensitive, a downtrend right in through here. The other thing is that the random walk oscillator is a very good divergence indicator. So you can see the maximum strength of the trend ended right here, and then even though you have this additional up move to the trend, it's not reflected on the RWO indicator right here. So you can see a definite divergence between here and here and here and here, and that same divergence is in the DIX. So this also gives you another clue as to why it's a good idea to get out of the trade right here when you've got this divergence with these indicators here. Now here's the final indicator in the triangle trend package, and that's called the Bollinger Band differential oscillator. When it crosses above zero right here, that indicates the equity is in an uptrend, and when it crosses below zero, that indicates the equity is in a downtrend. Now right here, 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 these all indicate an uptrend. So when all the indicators line up exactly the same way at the same time here, then you've got better than a 90% chance it's going to be a profitable trade here. And if you had a trend line in through here, that would be just icing on the cake. Then you could even have a higher degree of level of confidence if you had a trend line in through here. But certainly this is enough indication here that to justify going long right at this point here. Now the Bollinger Band differential oscillator is closely related to Fibonacci retracements. Now I put this Fibonacci retracement in here. Now the ambush zone is between 50 and 61.8. If the equity retraces to that zone and then starts back up again, then that indicates it's just a retracement in an uptrend. If it goes below the 61.8, that's a good indication that it's a downtrend. So here we go over here, and it just crosses below the 61.8 right here. If we go straight down from here, we can see that from here to here, we can see it just crossed below the zero line here, which indicates a downtrend. Now over here, when you had this retracement in here, this stayed well above the 0 line, and even though the midline dashes turned red, which indicated a little bit of a downward bias, it stayed well above the 0 line, which indicated there was not a downtrend in here. And then just to confirm that, I put in this Fibonacci level here, and you can see this pulled back to only about the 38% retracement. Didn't even get down to the 50%, which is right there, and this stayed well above the 0 line right here. Now here's a chart of the British pound and the US dollar. Now here's a trend line going across here. Here the currency pairs cross above the trend line right here. At the same time, the swing cycle turns green and moves above the variable band, which indicates this is, relatively speaking, oversold right here. And the DMI differential, the dots are green here, and it's just crossing above those dots right in through here. The DIX is already green, already moving up here, and you've already got the binary triangle showing an up triangle here. And at about the same time, the Bollinger Band differential oscillator is just crossing above the 0 line right in here. So you've got all these elements, all these components coming together right here, all indicating an uptrend. So if you go long here, you have better than a 90% chance that it's going to be a profitable trade. Now you can see this trend goes all the way up here, and you can see in this case it doesn't cycle within the trend. It just is a straight trend. And remember also that the trend is always stronger than the cycle. Now when the software determines that the trend has come to an end, it puts the final leg of this triangle right in here. But before that happens, the swing cycle has already moved down here. So you have a pretty good idea that this is coming to an end here, even before this indicator comes down here. But you've also got a down triangle formed right here, and the DIX has turned red and moved down here, and you can see the RWO is moving down right here. And so this is a good place to get out of this long trade. So you can maximize it by getting out right here, and you maximize it on this end by getting in when the trend is just beginning right here. So this is how you use the triangle trend indicators, and this is how profitable they can be, whether you use them on Forex or E-mini or whatever you want to use them on. They are just as profitable, in the basic concept stays the same no matter how you trade them or what equity you trade them. Now here's another example here. Now in this case, the trend line comes in kind of late here. Now the trend line is formed when this bar forms here, so the trend line has been here for some time. So I probably shouldn't say it comes in late, but it comes in quite a bit after the trend forms. And you can see how early the swing cycle moves up here, and it's showing an up cycle right in here. And of course, cycles often become trends. So a cycle will often precede the trend. So the cycle starts up here. You've got the green dots here, right around in this area. The DMI differential crosses above its 0 line. You've also got the DIX well above 0 in green right in here. You've got a binary triangle formed right on this bar right here. The RWO is showing an uptrend right in here, and the Bollinger Band differential oscillator is just about to cross its 0 line right here. So you can play this one of a couple ways. You know this trend line is already in here before you get to this point. You can see it. So the question is, you could either go long here, or you could wait till this trend line is crossed right here and then go long at this point. Now something else you can do is, since you know this trend line is in here, and since you know these indicators are moving up before it gets to the trend line, you can set a buy stop right on the other side of the trend line and catch it as it crosses the trend line right here. So there are a number of ways you can play this. Now here the swing cycle crosses below the variable band right here. The final base of the triangle is formed right here, and so this is where you might want to get out of this long trade right here. Now I wanted to show you what is called a failed cycle. This is a failed down cycle here. Failed cycle is a cycle that starts either up or down and never makes it to the 100% or the 0% level. So here's a failed down cycle. Very often when you have a failed cycle and it starts back up, the equity will move in that direction, which is also an indication why you always want to trade in the direction of the swing cycle VB. So in other words, you could have gotten out here, or since this was stayed green, you could have stayed in the trade and then gotten out when it turned red right here. So it all depends on your trading style. Now this was a failed up cycle here, and it turned red and started down, so then you have a significant down move here. Now I like to put the today's open on the chart and use these dots all the way across the chart, and this represents where the equity opened today. And that often serves as support and resistance, and so I probably would not have gone short when this trend line was crossed here, because I know there wasn't much room between here and the today's open, and also the DMI differential was staying green, staying above the dots here, so this would have been a very questionable short trade. Now here's another example. This is on the US dollar Japanese yen, and this is on a 2 Renko chart. And the dollar, the yen, generally doesn't have a wide range, and if you don't have a wide range, you can't really use 4 Renko. And so generally speaking, I don't like to use 2 Renko because there is more noise in a 2 Renko chart than a 4 Renko chart, and generally speaking, I don't think the US dollar Japanese yen is worthwhile to trade, simply because the relatively narrow range, and simply because it pretty much forces you to use 2 Renko. But I also put this on the chart to show failed cycles. Now here you have a failed down cycle, it goes up here. You have a failed up cycle here, and it comes down here, which makes a failed down cycle because this is the 0 line right down here. It doesn't make it anywhere near that, and then it starts up again. When it starts up again, you get this up move here, and then it's a failed up cycle here because this is 100% right up in here. So then it starts down, failed down cycle, starts up. When it starts up, you get this up move here, and then finally it turns red and moves down, and you get the down movement after it crosses below this trend line right in here. Now I put this chart on the screen to show that even though the swing cycle VB is an excellent indicator, it's still not a standalone indicator. And this is a long downtrend all the way across the chart here, and you can see the swing cycle VB is cycling up and down and up and down and up and down here, but you would ignore that because remember, the trend is stronger than the cycle, and also the DMI differential, the dots are red, it crosses below the red dots right here below before you come to this red trend line here, and then it stays down in through here. Even though you get 4 green dots here, it stays well below these green dots, which indicates that this trend is going all the way down here. So this is a way you can stay in a trend, and in this case you would ignore these up and down movements of the swing cycle VB right there. Here's another chart, the pound and the US dollar, another really easy trade to make. The equity moves above this trend line, which was put in way back here, and you get the swing cycle crossing above the variable band right here. You get the DMI differential showing an uptrend. The DIX is already up here, up triangle. You've got the RWO showing an uptrend right here, right in this area, and then the you've already been in an uptrend. This was a retracement and an uptrend, which pulled this back to the 0 line, and then it started up again here. So you know that this was a very, very high percentage trade to go long right here. And then you've got a red trend line here, and the swing cycle crosses below the variable band right here, comes back up to it. You have a failed up cycle right here, and then it's red, it starts down here, so you know this is going to be a nice down move in through here. So even though the DMI differential has not crossed below its 0 line right here, all the other indicators are showing that they're moving down. So this is where you could go short right in through here, and then you'd want to get out when this crosses above the variable band right here, and then you could go long over here when the indicators are all showing an uptrend. So you've got a number of trades on this one chart right here. And the final chart shows what time of day is best to trade, and here's the British pound to US dollar, and so you can trade that all day long and all night long. Yeah, so you can get good trades in this. So I think this is a preferable currency pair to trade, because it trades any time of the day or night that you have time to trade. Whereas the other equities in the 5 top traded pairs, and as I said, I would probably not trade the US dollar or the Japanese yen, and that would be because it just doesn't have the range of the other pairs right here. But in any event, around 8 o'clock or so at night Eastern time, they're all kind of moving up here, and then overnight they're good until about 5 or 6 o'clock in the morning, when they start being less tradable in through here. So I think this is a fairly good chart, and I kind of checked out these times, and they seem to pretty much hold true. And it also holds true that the pound and US dollar seems like a pretty good trade, no matter what time of night or day you trade it. So that's my presentation on the profitable Forex trading, and I hope you found this worth your time.